Hello, everyone, and welcome back to the Deep Dive. I hope you are having a fantastic week and are ready to tackle a company that, while operating almost entirely in the shadows, is fundamentally shaping the physics of the future. Today, we are undertaking a deep dive into Synopsys, ticker SNPS. This is the company that sells the invisible architectural blueprints, the design software, and the foundational building blocks for virtually every advanced computer chip in the world. I mean, they are the definition of an indispensable player, yet so few people outside of the semiconductor industry truly understand their absolute centrality to this whole AI revolution. On the surface, Synopsys looks like the perfect investment thesis. You've got a powerful, rational duopoly, nearly 80% recurring revenue, and massive exposure to the most powerful secular trends we've ever seen. But the real question, the central dilemma we have to answer for you today is this. Is this company truly an inescapable Tollbridge for the AI era, providing that, that highly desired blend of bond-like stability and equity-like growth? Or are the massive geopolitical risks and the vertigo-inducing valuation, and we're talking 50 times plus expected earnings, are those ignoring critical hidden cracks in the fortress? That is the mission of this deep dive.
That's a massive question, and one we absolutely have to get right because the quality of the underlying business here, as you said, it's undeniable. But before we get into the architectural details, just a quick note for everyone joining us on this deep dive.
For those of you who want to act on these investing ideas, having a professional-grade platform that can handle the nuance of global markets and, complex research is key. We personally use and rely on Interactive Brokers, and we've actually partnered with them to offer our viewers a stock bonus when they sign up and fund their accounts through our channel link below.
So you get a powerful tool for your own analysis and portfolio management, and you support the channel at the same time, which helps us continue to produce this level of in-depth analysis. That link is conveniently placed in the description section right below.
That's right. And of course, if you find value in this kind of rigorous, in-depth discussion, the single best way to let us know and to ensure you get the next analysis automatically is to hit that subscribe button and like this video. It truly helps the channel, and we invite your questions and comments in the section below. We love seeing what stands out to you.
Perfect. Now, stepping away from the market execution and back into the architecture, let's revisit that core idea you brought up, the inescapable Tollbridge. We really need to start with the foundation, the business model, and the sheer durability of its competitive fortress.
Okay, let's unpack this. We call Synopsys the inescapable Tollbridge. And to understand why that term isn't just, hyperbole, we need to first break down exactly what they sell, because it's not physical silicon. It is intellectual property and proprietary software.
Absolutely. When you look at their revenue generation, it basically simplifies into two major streams. And both of them are high quality, incredibly sticky, and essentially recurring in nature. The first one is electronic design automation, or EDA, software licensing. This is the bedrock of the whole thing.
EDA.
And the EDA tools are the highly specialized, proprietary computer-aided design software, CAD software, that engineers use to actually design, simulate, verify, and then ultimately sign off on the layout of a chip.
And that's a process that has become just exponentially more complex with every single generation of silicon.
Yeah, exactly. I mean, it's just off the charts now.
So if a chip design is like a massive 100-story skyscraper, the EDA software isn't just the modeling tool. It's the structural analysis tool, the compliance auditor, and the final building inspector, all rolled into one highly proprietary package.
That's a great analogy. And that revenue, because no chip is ever finished in a growing industry, it's highly predictable. It's all based on recurring subscriptions. Exactly. And then the second stream, which synergizes powerfully with the first, is intellectual property, or IP, blocks licensing. These are pre-verified, ready-to-use digital components. They're essentially licensing the internal machinery of a chip.
Oh, that IP analogy is fantastic. So instead of the architect having to design every single steel beam, every elevator shaft, and every specialized duct system from scratch, which takes years and risks a catastrophe, they just license a pre-certified, pre-tested component that's ready to just drop right into the blueprint.
Precisely.
What kind of components are we talking about here? I mean, what are these IP blocks?
We're talking about the absolute necessities for any modern high-performance computing chip. Things like the USB controllers, the PCIe interfaces, the DDR memory controllers.
That has to be there.
It has to be there. And the really complex SerDes components used for high-speed data transfer. These blocks are incredibly difficult to design and verify, especially when you get to the cutting-edge 3 nanometer and 2 nanometer process nodes.
The simplicity here really speaks to the endurance of the business model. I mean, they are selling the digital architectural blueprints and the specialized tools that you have to have for chip design. This makes their necessity just non-negotiable.
It is non-negotiable. If you want a state-of-the-art chip, you must use their toolchain, period.
Yeah.
And it's important to stress how enduring this is. For decades, the complexity of chip design has been managed through abstraction and automation. Synopsys and its main competitor have completely cornered the market on those abstractions. So as long as human demand for more computing power and more connectivity exists, the complexity is just going to keep rising, which makes their automated solutions even more essential.
And here's where it gets structurally really interesting, though. The customer base itself is expanding dramatically. It used to be just, Intel, AMD, Qualcomm, the traditional chip fabrication and design houses. But now we have this massive structural trend that they call the silicon to systems trend.
That trend is the guaranteed accelerant for demand. It fundamentally broadens Synopsys' revenue base away from, say, a cyclical chip market exposure. You've got companies like Apple designing their own M-series and A-series chips. You've got Google with their proprietary TPUs and server ASICs.
Even car companies, right?
Even major automotive firms and EV makers are designing bespoke silicon for autonomous driving and for battery management.
So these are systems companies that sell phones or cloud services or cars, who have realized that the only path to truly differentiated performance, power efficiency, and security is to control the hardware design right down at the transistor level.
Exactly. And when Apple or Google decides they need a new chip, they don't suddenly decide to spend $1 billion and hire 1,000 people to write their own EDA tools from scratch.
Of course not.
The barrier to entry for EA is just way too high. They immediately become Synopsys customers. This trend guarantees that the customer base expands well beyond the traditional chip makers, providing a secular tailwind that is just. It's really difficult to slow down, let alone stop.
Okay, that brings us right to the moat. We call it a fortress. But what exactly prevents a well-funded competitor, or even one of those large hyperscalers, from just coming along with a cheaper, faster tool and taking Synopsys' business?
The primary moat is a combination of extremely high switching costs and their massive portfolio of intangible assets, specifically that certified IP library we talked about. But the switching costs here, they're not just high in the typical software sense, they are astronomical, especially for the most advanced chips being designed today.
Okay, let's dedicate some serious time to this. Let's detail that moat in action. Let's imagine a real-world scenario. Say NVIDIA is designing its next major AI GPU. Let's call it the Blackwell successor, a truly complex design using a cutting-edge 3-nanometer process. We're talking about a team of maybe 500 highly skilled, highly specialized engineers working on this project.
Correct. And that team has spent years, often a decade or more, mastering Synopsys' specific workflow. And we're not just talking about learning a button layout. They have mastered the specific scripting language for automation, the proprietary physical verification tools, the specific timing analysis methodologies, and the critical sign-off procedures that guarantee the chip will work as intended once it comes back from the foundry.
So it's an entire, deeply integrated ecosystem of specialized knowledge.
It is. So to switch to the competitor, Cadence would require retraining those hundreds of highly paid specialized staff.
But wait, you mentioned the IT blocks. Doesn't selling those make them more vulnerable to competition, especially now that their partner, ARM, is getting more aggressive in IT licensing?
That's a crucial challenge, and it really shows the synergy of the duopoly. While ARM is a massive IP provider, especially for CPU cores, Synopsys' competitive advantage in IP lies in the interfaces and the compatibility. Synopsys' IP is pre-verified to work perfectly within the Synopsys EDA environment. That means the risk of an integration failure is near zero. If you switch to another EDA tool, you risk incompatibility, which forces you to verify that IP block all over again, and that defeats the entire purpose of licensing it for speed in the first place.
So the cost of retraining is significant, but it's the risk profile that makes this truly frictional.
Absolutely. The consequence of switching isn't just a few months of reduced productivity. It risks critical product launch delays, which, for a company like NVIDIA in the AI race, could cost them not millions, but billions in lost market share and opportunity costs.
Billions, yeah.
And worse still, it risks introducing fatal undiscovered bugs into the physical chip itself because of an unfamiliar toolchain or some glitch in the transition.
And what's the financial exposure on one of those prototypes? A tape out, right? That's the point where you commit the design to the foundry.
That's right. For a leading-edge tape-out, Fabricating the first prototype run of a complex 3 nanometer or 2 nanometer chip costs upwards of $50 million. Sometimes it approaches $100 million for the largest dies.
50 to $100 million.
So if you introduce a fatal bug because of a workflow change or an error in a new toolset, that enormous capital outlay is instantly incinerated, and you lose another 6 months or a year of crucial development time.
So, if they stumble on a single design error because they were trying to save a relatively minor amount on software licensing, they are instantly incinerating $50 million and 6 months of market lead. I mean, that calculation alone explains the entire moat better than any financial statement ever could.
Precisely. The conclusion for any executive calculating this risk is straightforward. The frictional cost of leaving a verified, trusted, and integrated toolset like Synopsys is effectively infinite for any leading-edge chipmaker. You simply do not risk your entire business model over software that represents a fraction of a percentage point of your total R&D budget.
It's a rounding error in the grand scheme of things.
It is, and this perfectly illustrates that Tollbridge mental model. You cannot cross the river to a finished working state-of-the-art chip without paying the recurring toll to Synopsys or Cadence. There is no unregulated alternate route.
It's a private bridge, and they own it.
They do, and this feeds right into the Lollapalooza effect, a concept highlighted by Charlie Munger, where multiple moats synergize and reinforce each other. The combination of the specialized EDA tools and the massive verified library of IP blocks reinforces the advantage nonlinearly. The customer gets stuck not just on the tools, but on the content, the thousands of certified blocks, making it nearly impossible for a new entrant to break this highly rational, entrenched duopoly.
So we're talking about a classic rational duopoly that's usually excellent for pricing power and margin expansion. Who exactly are the players here?
It's essentially Synopsys, the dominant incumbent in certain key areas, and Cadence Design Systems, ticker CDNS, which often leads in areas like physical verification and maybe analog and mixed signal design.
We often call them the Coke and Pepsi of EDA.
That's exactly what they are. Then you have Siemens EDA, which was formerly Mentor Graphics, as a distant third player. They're usually focused on specific niche areas like PCB-printed circuit board design or specific verification methodologies, but they're not truly challenging the duopoly at the leading edge of digital design.
Not in the same league.
Not at all. The critical point is that these two firms, Synopsys and Cadence, have developed their own domain advantages over decades. They have these strongholds where they dominate the engineer's workflow.
Okay, so where does Synopsys hold this specific dominant advantage that its rival struggles to penetrate?
Synopsys holds the dominant lead in what's called digital logic synthesis. This is the core process of automatically translating the high-level design language written by the human engineer into the final physical layout of logic gates.
So that's the most critical part.
It is perhaps the most complex and mission-critical part of the entire design flow. And furthermore, they dominate in interface IP. As we discussed, these are the crucial controllers: USB, PCIe, and DDR memory controllers. These components are mandatory in every high-performance computing chip, from iPhones to high-end servers.
And that IP library, as you said, is the speed-to-market edge that translates directly into cash flow for their customers.
Precisely. If I'm a chief engineer at a leading chip design firm, I cannot afford for my 500-person team to spend 6 months verifying a high-speed PCIe 6.0 controller when Synopsys can just license me a pre-verified version that they guarantee will pass their sign-off tools.
Right.
It allows customers to assemble the most complex parts of the chip, like certified Lego sets, rather than having to design every single component from scratch.
And that dramatically reduces time, risk, and cost. It's a structural advantage that ensures the best customers, the ones working at the bleeding edge, will always choose the path of least resistance and maximum certainty, regardless of the licensing price.
The analysis of the business quality is incredibly strong, but good investing is always about looking forward. We need to analyze the strategic moves management is making to ensure this moat not only stays wide, but aggressively widens further, especially in the face of next-generation complexity.
Right, and the company saw a big transition from its longtime founder, Art DeJuice, to the new CEO, Sassine Ghazi. His philosophy seems to be driving a very significant, very aggressive strategic shift.
Ghazi's philosophy is captured perfectly under the banner of silicon to systems. It's an aggressive pivot that recognizes that chips are no longer simple 2D puzzles etched onto silicon. They are increasingly complex, vertically integrated 3D systems. We are stacking memory, stacking logic, and connecting all these heterogeneous cores in densely packed packages.
And the centerpiece of this philosophy, and arguably the most significant decision in the company's recent history, is the massive acquisition of Ansys. This was not a small tuck-in acquisition. This was a bet-the-company level move.
It absolutely was. At an estimated valuation of $35 billion, this transaction just dwarfed Synopsys' historical size and fundamentally changed their financial profile overnight.
$35 billion.
Wow. But the strategic rationale for acquiring Ansys is it's brilliant from a moat widening perspective.
Explain that.
Okay, so Synopsys historically dominated the purely digital logic and electronic design software space. Ansys dominates the physical reality space, so physics simulation.
And what does physics simulation mean exactly in the context of a hyper-complex 3D stacked chip?
It means modeling the reality of physics that destroys performance. When you stack high-power chips on top of each other, heat dissipation is the primary performance killer.
The enemy, yeah.
It's the enemy. So you need sophisticated tool to model thermal expansion, material stress, vibration, and crucially, electromagnetic interference, EMI, and power integrity issues that arise when signals are running at near light speed in such close proximity.
So by integrating Ansys,
By integrating Ansys' world-class physics simulation capabilities directly into the Synopsys EDA suite, they dramatically expand the moat. The combined suite becomes even more indispensable because customers no longer have to export their nearly finished digital design to a separate external physical simulator and then manually adjust the design to fix issues like hotspots or electromigration.
that dramatically simplifies the workflow, speeds up time to market, and adds another layer of frictional cost if a customer ever thought about leaving. It makes the tools exponentially stickier.
Precisely. This acquisition demonstrates a true owner-operator mindset. It sacrifices short-term financial optics, specifically by loading up the balance sheet with significant debt, in favor of securing long-term strategic dominance in the face of ever-rising system complexity. Management showed a willingness to endure short-term pain and a lot of investor concern for the massive reward of creating a unified end-to-end design environment.
When you operate a mission-critical Tollbridge like this, the relationship with the customer is often complex. Let's look at the customer sentiment, the market scuttlebutt, from the thousands of engineers who actually use these tools every single day.
The analysis confirms what you often find in these duopoly software situations. Customers view Synopsys as mission-critical rather than genuinely loved. They rely on it, they absolutely cannot live without it, but it's not necessarily a product that evokes affection.
I love that observation that in technical reviews, boring and accurate is the highest form of love in chip design.
It's the perfect description of their value proposition. Reliability trumps speed or aesthetics every time. If the tool is boring, it means it's predictable, and predictability means a low risk of a catastrophic failure that incinerates $50 million.
That's what they're paying for.
That predictability is what they're selling. However, there is a legitimate critique here. Legacy EDA tools are often incredibly complex, with decades of features layered on top of each other. The term bloatware is a common industry whisper.
Bloatware, interesting.
Describing the sheer volume and intricacy of the features and modules. It's powerful, but it comes with an incredibly steep learning curve and requires massive internal IT infrastructure to support.
Okay, so moving from the customer to the internal perspective, what's the feeling on the ground among Synopsys employees, especially considering the rapid scaling in this huge culture-merging move like Ansys?
Historically, employee sentiment has been very strong. It's highly attractive for the best engineering minds because it is the ultimate intellectual sandbox. They are working on the absolute hardest physics and design problems in the world, with the promise of high stability. However, this is where the integration challenge really surfaces, and we have to flag this as a key short-term risk. Recent reviews hint at definite growing pains. Rapid scaling and the massive cultural inclusion of a large established entity like Ansys introduces significant culture dilution risk. There's friction noted between the legacy Synopsys engineering culture, which might be more focused on technical purity and deep R&D, and the new aggressive growth targets and financial metrics being pushed by the management team post-merger.
And that cultural friction is so critical because it ties directly back to the investment thesis. If you pay a massive premium for synergies, those synergies are only realized through the successful collaboration of human capital. people have to work together.
Absolutely. The integration challenge, both cultural and technical, is a primary risk factor right now. If key high-caliber engineers decide to leave because of cultural clashes or changing priorities, or if the product integration of the Synopsys EDA and Ansys simulation tools is clunky or fails to deliver that promised unified environment,
And the whole thesis is in jeopardy.
the financial justification for the deal collapses. Those touted $400 million in synergies needed to justify the high price tag may simply evaporate. As investors, we need to be monitoring employee retention and early product feedback on the integrated tools very, very closely.
Okay, let's shift now to the stewardship of the business. The quality of the underlying product is established, but execution, capital allocation, and financial health are what truly compound value over decades.
Right. And when we examine management's historical commitment to R&D, it's not just strong, it's extraordinary. They consistently spend approximately 30% of their annual revenue on research and development.
30%, that's a huge number.
It's a crucial data point. That is a very high mark for any company, let alone a mature, large-cap software entity. It demonstrates a deep, non-negotiable commitment to staying ahead of the complexity curve. That 30% R&D spending is the Moat maintenance cost. It ensures the software remains compatible with and capable of designing the next generation of chips that push the laws of physics.
It's a recurring, necessary expenditure that underwrites the Tollbridge's durability. Now, looking at incentives. Executive compensation is heavily weighted towards performance equity, PSUs, tied to metrics like revenue growth and non-GAAP EPS. This seems to successfully align management with growth, which is exactly what a high multiple company requires.
It does, but there's a critical metric we'd prefer to see tied in more explicitly, especially given the sheer scale of the Ansys deal. That missing metric is a stronger, explicit tie to return on invested capital, or ROIC.
Okay, so given the massive capital outlay and debt taken on for the Ansys merger, why is emphasizing ROIC so crucial right now?
Because ROIC is the ultimate measure of management efficiency. It shows the shareholder how well management is generating profit from the capital they employ. Now that the capital base has expanded so dramatically, we're talking tens of billions in new debt and equity showing shareholders that management is accountable for maximizing returns on that large base would provide significant long-term comfort and discipline visibility.
Especially with the founder stepping back a bit.
Exactly. While founder Art DeJuice retains influence as chair, greater visible emphasis on ROIC is essential for the long-term capital allocation story.
And historically, capital allocation has been rational balancing that high organic R&D with strategic M&A and some tactical buybacks. Now, post-Ansys, the priority shifts entirely, doesn't it?
It does. Before the merger, share buybacks were used strategically to offset dilution and return capital. Post-Ansys, the clear stated priority is aggressive debt reduction. And that's a sensible and necessary focus given the immediate change in their balance sheet profile. The market needs to see that high cash flow being used to restore the balance sheet fortress.
Okay, let's review the financial quality. The consistency here is really the hallmark of a premier software duopoly.
The profitability metrics are exceptionally consistent and high quality. Gross margins consistently hover near 80%. When you are selling intangible intellectual property and specialized software, those margins just confirm the existence of a massive pricing power advantage and a deep moat.
And operating margins.
Operating margins have also been steadily expanding, moving into the mid-30s, which confirms they are highly skilled at converting that recurring revenue into significant high-quality profitability.
And that margin profile leads to high-quality cash generation, I assume.
Absolutely. Free cash flow quality is high, with net income converting to FCF at a very healthy rate. It's important to acknowledge, however, that 2024 and potentially 2025 are seeing temporary dips in reported FCF.
Why is that?
It's due to necessary merger-related cash outflows. These are the integration costs, the financing costs, and working capital shifts. This is something the sophisticated investor has to look through, provided we are confident the underlying integration will succeed.
Now, let's talk about a classic financial trap that often catches new investors, what we call the ROIC nuance. Historically, Synopsys' ROIC was stellar, sitting around 14 to 17%, a sign of a great compounding machine. Today, however, that number looks severely depressed. Why is that?
This is a crucial teaching point for the learner joining us today. If you look at the trailing 12 months, or TTM ROIC, it might appear abysmal, maybe 3 or 4%. The reason is mechanical and related directly to the Ansys deal structure.
Okay, break that down.
ROIC is fundamentally a ratio. Net operating profit after tax, the numerator, divided by total invested capital, the denominator. The Ansys deal required a massive expansion of that denominator. They issued significant new debt and equity, so this capital hit the balance sheet immediately. However, the earnings from Ansys are highly backloaded. They take time, 12 to 24 months, to materialize, stabilize, and flow through the net income statement.
Ah, so the denominator, the invested capital, spiked instantly by tens of billions. But the numerator, the net operating profit, has barely moved yet because their earnings haven't been realized.
Precisely. That temporarily and artificially crushes the ROIC metric. The learner needs to know that this is a temporary distortion. We have to look through this dip and assume that if the integration is successful, ROIC will revert to its historical stellar range once the Ansys earnings are fully realized and the priority debt reduction is executed.
Finally, let's address the elephant in the room. The balance sheet vulnerability created by taking on this large acquisition debt.
The financial fortress now has a noticeable short-term chink in its armor. The net debt to EBITDA ratio spiked dramatically. Synopsys historically ran a very, very conservative balance sheet with that ratio around 0.5x.
And now?
Post-merger, depending on the exact timing, that ratio spiked up to somewhere between 3x and 6x.
That's a big jump.
This high level of leverage is the price paid for strategic dominance. It is a temporary vulnerability that exposes the company to greater interest rate risk and puts immense pressure on management to execute the integration flawlessly. The commitment, however, is clear. Management has pledged to deleverage aggressively, with a target of bringing that ratio back under 2x within 2 years. Their high-quality, recurring FCF generation gives them the capacity to do this, but the next couple of years are crucial in proving their financial resilience.
We've established a high-quality, indispensable business that is currently digesting a massive strategic merger. The next question is existential. What drives the next phase of growth, and what are the major risks that could permanently impair the equity story?
It seems obvious that the primary engine is AI, but let's go deeper than the buzzword. Why does AI fundamentally change the necessity of Synopsys' tools rather than just being a cyclical upgrade?
Right. What's the real mechanism here?
It comes down to the simple reality of physics and the limits of human capacity. We are now designing advanced AI chips, the latest Hyperscaler ASICs or massive NVIDIA GPUs that contain trillions of transistors. The design space for these chips is so vast, and the constraints, power, heat, timing, interference, are so finely balanced that human engineers can no longer physically design and optimize them alone. It's impossible.
They need help.
This complexity creates a desperate, non-negotiable need for AI-powered design tools. Synopsys.ai is their unified platform. It uses machine learning and sophisticated optimization algorithms to explore billions of possible physical layouts, optimize power usage across the entire die, confirm physical constraints, and verify timing closure in a fraction of the time a human team could ever achieve.
So if you want to build the future of AI, you absolutely need Synopsys' AI tools. This cements their role as central to future innovation. They're effectively charging a tariff on the future of computation itself. They become the gateway.
Exactly. They are the gateway.
Besides the baseline secular growth from complexity, what are the specific events that could accelerate Synopsys' growth and allow them to flex their pricing power even more?
We are tracking two major industry-wide technological shifts that could act as powerful catalysts. The first is the anticipated rollout of what we call Agentic AI in the design process, likely surfacing around 2025 to 2026.
You mentioned Agentic AI, previously moving beyond simple automation to AI collaborating with AI. Let's define this more clearly for the learner. What capability are we really talking about?
Okay, so Agentic AI means moving beyond simple automation scripts to sophisticated, goal-driven systems. We're talking about AIs that can break down a complex chip design problem into subtasks, manage resource allocation between different design blocks, and dynamically adjust thousands of design constraints based on real-time simulation feedback from the Ansys tools. And ultimately, it can present a final, fully verified design block. Essentially, it's an AI chip designer that reports to the human chief engineer. And this shift drives a massive forced upgrade cycle. Chip makers cannot afford to be without these efficiency gains, which can cut design time by months. When Synopsys rolls out these tools, they inherently increase their pricing power per seat. because the productivity gain is so vast that the cost of the software becomes a negligible fraction of the overall R&D budget.
And the second catalyst is a huge physical shift in how the transistors themselves are structured, right?
Yeah.
We're moving away from the FinFET transistor architecture to gate-all-around, or GAA, architectures.
Correct. The GAA transition is a generational, industry-wide shift in the fundamental transistor architecture. Every major chipmaker, TSMC, Samsung, and Intel, is moving to GAA to continue scaling past the 3-nanometer equivalent node. This is a complete physical redesign of the transistor.
So the old tools don't work anymore.
This transition requires fundamentally new, compatible, and incredibly complex toolsets for everything from simulation to physical verification. Because the old FinFET optimized tools won't work correctly with GAA, it forces every single chipmaker to buy new tools, often upgrading their entire Synopsys platform from scratch. This guarantees a surge in demand and capital expenditure for Synopsys' specific products, regardless of the broader macroeconomic climate.
Okay, so we've built up a very strong bull case based on inevitability, complexity, and structural growth. Now we have to flip the script and focus on the risk that could permanently impair the business, turning a high-growth stock into, perhaps, a stable utility stock.
The biggest immediate and unmitigated risk is geopolitical decoupling, specifically related to China. China historically accounts for a significant material percentage of Synopsys' total revenue, typically in the range of 11 to 15%.
Which is not a small number.
Not at all. And recent export controls by the U.S. government have already forced management to de-risk its financial forecasts. A total, comprehensive ban on selling advanced ED tools to Chinese entities, or a severe retaliatory Chinese ban on U.S. software, would not be a cyclical downturn that just rebounds in a year. It would be a permanent stair-step down in global revenue, potentially stripping away 15% of the sales base overnight.
And that is an external, unmitigated risk that management can do absolutely nothing about other than comply, and it permanently lowers the base from which all future growth is projected.
Precisely. And the strategic consequence is profound. If they lose that 15% of revenue, they must either cut their industry-leading 30% R&D spending, which risks their technological dominance, or they absorb the loss and accept a permanently slower global growth rate.
A very tough choice.
A very tough choice. The second permanent impairment risk is technological. It's the hypothetical, but perhaps inevitable, Moore's Law wall.
The idea that physical scaling of chips must eventually stop because we just hit the atomic limits of physics.
Exactly. If the laws of physics eventually halt the ability to shrink transistors and continue scaling processing power, the industry dynamics change completely. The desperate, decade-long need for newer, more expensive, and more complex EDA tools designed to push against the limits of physics, could just plateau.
And the urgency disappears.
The urgency disappears. And if that happens, the chip design industry shifts from a perpetual growth cycle focused on breakthrough innovation at the leading edge to a stable utility cycle focused on just optimizing existing mature process nodes. And a utility model, even a duopoly utility, commands substantially lower valuation multiples than a high-growth compounder like Synopsys currently enjoys. This would lead to long-term multiple compression, regardless of the quality of the underlying profits.
We've established the quality of the business is near flawless. The risk is less about the strength of the moat and more about the price you have to pay for admission. So we need to confront the valuation vertigo that often accompanies these high-quality compounders.
Synopsys has absolutely earned its premium valuation. It historically trades at 30 to 45 times earnings, reflecting its duopoly status, the reliability of its recurring revenue, and the market's perception of it as a low-volatility pick-and-shovel AI safety play.
Right, you get the upside without some of the volatility.
It allows investors exposure to the immense AI boom, but with substantially lower cyclical volatility than direct chip manufacturers who have to deal with inventory swings and sudden shifts in capital expenditure budgets. Synopsys gets paid regardless of whether the chipmaker successfully sells the final product.
So when you look at a compounder of this quality, the traditional margin of safety, buying something cheap, it just doesn't exist. Where is the safety found in this investment?
For a stock like Synopsys, the margin of safety is found in the duration of the growth. How many years can they compound those earnings at a high rate, and how resilient is that growth to downturns? The longer the runway, the more valuable the stock is today.
But that safety can be disconnected by fear.
It can. This perceived safety can be temporarily disconnected by fear. If geopolitical risks flare up, say, another round of sanctions aimed at limiting technology transfer to certain regions, it often triggers a temporary price disconnect from its long-term cash generation power. That fear creates the opportunity for long-term holders.
But let's look at today's price. If you're paying above 50 times earnings, which the stock has frequently approached, the hurdle is just incredibly high. You have to run a very aggressive discounted cash flow model to justify that.
It is the final hurdle, and it requires deep conviction. Paying 50 times earnings requires a high probability assessment that the company can double its earnings every 3 to 4 years for the foreseeable future. The margin for error is essentially zero. And the risk here is simple. If Synopsys stumbles on the Ansys integration, or if broader economic headwinds slow down semiconductor capital expenditure for even a year or two, the market will react harshly, not by lowering the valuation of the business, but by compressing the multiple it's assigned.
And if that multiple compresses, say, from 50 times earnings down to a still respectable 25 or 30 times earnings, that would decimate returns, even if the underlying business continues to grow slowly. You need sustained, rapid, high-speed growth to justify this premium valuation, proving that the duration of that toll bridge is truly indefinite.
The consensus view is powerful, and it's simple. Synopsys is a safe, necessary way to play the massive trend of AI development. But we must challenge consensus. We have to run the red team challenge to invert the bull case and look for those existential threats.
We have to consider the ultimate long-term disruption risk, which we call the Nokia trap. We saw Nokia completely dominate mobile phones only to have a new paradigm smartphones, render its core competitive advantage obsolete almost overnight.
The analogous question here is this. What if AI eventually allows the hyperscalers, Google, Meta, Amazon, Microsoft, to build their own internal proprietary design tools? They are already designing some of the world's most advanced custom chips. They certainly have the engineering talent and the immense computing power needed.
So they just bypass the toll bridge.
They bypass the toll bridge entirely. If these internal teams, powered by their own vast pools of proprietary data and custom generative AI models, become good enough to design cutting-edge ASICs without needing the generalized legacy EDA tools from Synopsys, the entire duopoly dynamic changes.
That sounds like a monumental task, though. I mean, Synopsys has 30 years of legacy code base and verification history built up. Can a hyperscaler really replicate that, or would they even need to?
That's the critical subtlety. The hyperscaler threat isn't replicating the last 30 years of tools. It's creating a tool focused only on the next 5 years of process nodes. They don't need to support 100-nanometer processes or obscure legacy features. They only need to design their own 2-nanometer ASICs. That narrow, hyper-focused application, combined with massive internal data on what works and what fails, is their competitive edge against Synopsys' broad legacy code base.
So the threat is that generative AI could change the whole game.
If generative AI becomes sophisticated enough to design chips from high-level specifications without relying on Synopsys' legacy code base, the moat isn't just breached, it's evaporated. The key intellectual property shifts from the EDA vendor to the systems designer. Buying today at peak multiples fundamentally assumes this extreme structural disruption is impossible, or at least far beyond the 10-year investment horizon. That is the critical risk a long-term investor must weigh against the immediate moat strength.
Okay, so to synthesize this deep dive, we have a company whose product is truly essential, an inescapable toll bridge that benefits from structural trends like silicon to systems and the explosive complexity driven by AI. The business quality is secured by astronomical switching costs, an indispensable IP library, and a powerful duopoly position, recently reinforced by that aggressive, strategic move to acquire Ansys.
However, that structural durability is currently balanced against 3 significant short-term headwinds: the digestive challenges of the Ansys integration, the resulting temporary increase in balance sheet leverage, and the permanent risk of geopolitical decoupling, particularly with China. The investment decision ultimately rests on balancing the absolute indispensability of the product with the steepness of the valuation hill you have to climb.
That leaves us with one final provocative thought for you to mull over. We know that AI, through tools like Synopsys.ai, is the biggest catalyst driving the company's current growth and market multiple, but we must constantly ask, does the very technology that is driving Synopsys' revenue-generative AI also possess the hidden potential to eventually make the company's legacy competitive advantage obsolete? This requires you, the sophisticated learner, to monitor the internal design team capabilities and proprietary AI tools at the hyperscalers, Google, Amazon, Meta, as closely as you monitor Synopsys' next quarterly sales figures. The disruption, if it comes, will come from within the industry they serve, challenging the premise of the toll bridge entirely.